Welcome to the Fullerton Financial Show with the founders of Fullerton Financial Planning, Stephanie and Steve Fullerton, a program designed to empower you to live financially confident in retirement. From income planning and wealth management to healthcare, defending against taxes, and leaving a legacy. Stephanie and Steve share the strategies and insights you need to help achieve retirement success. This is the Fullerton Financial Show.
Hi, I'm Megan Mozak, joined by Stephanie and Steve Fullerton of Fullerton Financial Planning right here in the Valley. We'll tell you how you can potentially save on taxes in retirement here on the show today. And Stephanie, Steve, it's great to be back with you.
Thank you.
You know, there is a lot we can't control. We can't control the weather or the traffic here in the Valley. Stephanie, you cannot control your spouse.
I was just going to say, you can't control your spouse.
Right.
This is true. We all know that. But there are some things we can control, and taxes, surprisingly for many of us, is one of those things. How can we do that?
Well, we want to look at what is it that we haven't paid taxes on yet. Megan, we all know that come 2025, 2026, we've already have it in place. It's called the sunset clause. So we know it's going to happen. At least that's what we've been told. Taxes are going to go up. So we're going to go back to where we were back in 2017, before the Trump tax cuts. So because we know that, then we want to be very proactive. And it's interesting because I will have people come in and say, well, I've retired and my advisor told me not to worry about it. And we take a different approach. We begin to take a look. It doesn't make sense. Is it the time and the opportunity for us to take advantage? I say taxes are on sale right now. So do we go ahead and do some conversions? Meaning, do we take the IRA that we've never paid taxes on, get the taxes out of the way? I think a big misconception for a lot of people is, hey, I'm going into retirement, I'm not going to pay as much in taxes. And that really is a dangerous mindset, because probability you're going to remain in the same tax bracket, if not maybe even higher.
Steve, talk about this fallacy that's out there among so many people in or nearing retirement that says you can't use tax planning to be more tax efficient.
Well, have you ever seen the movie Field of Dreams?
Absolutely.
And one of the famous lines in the movie is, "Build it and they will come." Well, what I'll say on taxes are this: ignore them and they will come.
Right.
They're coming. So there's a fallacy, like Stephanie mentioned, that when we're saving for retirement through our 401ks and our IRAs, that we're saving tax deferred money, always tax money, for a point in time when we receive it in income when we're retired, and our income bracket will be lower. And that's the fallacy, is most times that's not true. So it's really, really important to take a look at how we can pay our tax, because we should pay once the lowest amount by law that we're required to pay, and get it at a discount rather than an inflated price. If you're taxed at 40%, that means out of every $1, I get 60 cents. That is not a good plan. So we look at ways to diversify and to save on taxes. The old Fram oil filter commercial, for those that can remember, the guy held up a Fram oil filter and he said, "Pay me now
Or pay me later."
And he had a hood of a car, or your engine seizes up and you're going to pay a whole lot more down the road. So that's what we look at.
I think a lot of us remember that commercial and it stuck with us, but it's a really good analogy, right? Face it now while tax rates are low rather than later when they go up. Let's talk about the first step, Stephanie. If someone recognizes, okay, I want to take control, I want to be proactive, what's the first step to being more tax efficient in retirement?
So we're going to take a look at tax brackets. We're going to do a very extensive dive into what are you going to be required to take out when you do hit that minimum distribution age. Uncle Sam says you have to take this money out. Well, Megan, what if you don't need that much, but you're forced to? Again, what could happen? It could put you in a higher tax bracket. So we're going to begin to be very proactive about that. You know, another thing a lot of people don't even talk to folks about is this. Did you realize that when you get to where you're required to take out a distribution, So Megan, let's say that you have a lot of charities that you like to give to, nonprofit. Do you realize that you could actually take that distribution, bypass you and put it to that charity and not be taxed on that distribution and even get the contribution for it? People don't even know that. Or maybe there's some donor advisor funds that we could set up for you that would give you a lot of tax benefits today to create tax benefits down the road. So there is so much strategies and value that we bring to our clients. I would even say we have saved thousands and thousands and thousands of dollars if you begin to take a look at the accumulative of all the tax strategies that we use. So a lot of different funnels, a lot of different ways, but again, it's about sitting down with you, looking at what's right for you, because what's right for you might not be what's best for the person right next to you. That's the value that we're going to bring to you when you come into our office.
And that really is the goal. I know you talk about it a lot at Fullerton Financial Planning, looking at each person as an individual because everyone's situation is so different. It's that comprehensive approach. Love to hear that tax planning goes into that. It's so key to keeping more of your hard-earned dollars. All right, we're going to keep this conversation going, Stephanie and Steve. And the bad news is that taxes can be a big expense in retirement, as you've just heard. But the good news is you do have options to help lower your bill. Stephanie and Steve explain that coming up next. Plus, in any race, the final lap can be key to victory. In this week's Fullerton Factor, find out how you can prepare and take a victory lap in retirement. Stay with us.
Just when you may want to forget your age, Uncle Sam says not so fast. Knowing your age is more important than ever when it comes to taking your required minimum distributions, or RMDs. Legislation just changed the age requirement, and not accounting for that could impact your retirement plan. It could be key to not overpaying on taxes in retirement. So remember, when it comes to RMDs, age is more than just a number. Before your next birthday, call today to secure a strategy for the RMD age change and your retirement.
Welcome back to the Fullerton Financial Show.
Did you know taxes could be your largest expense in retirement? It catches a lot of retirees by surprise, but there are ways to potentially lower your tax bill. We want to talk about that with Stephanie and Steve today. What are some of our options?
Well, there are different options. There's always tax money, like tax deferred money and an IRA or a 401k. That's really long-term, not a tax savings. It is up front. Then there's tax advantaged accounts, brokerage accounts or things like that, where you've paid tax on the money and then you only pay tax on the gains. And whether it's a long-term gain or a short-term gain, depending on how long you've had it, there could be some tax favorability in there. Oh, and by the way, there's talk of that changing as well, as far as tax train coming down the tracks, I'll put it that way. And then third, there's money that's once taxed, never taxed again. And that's our favorite kind of money. And there are different types of strategies. A Roth IRA or a Roth 401k would be an example of that. There's some life insurance strategies that have to do with that as well. But so there's different ways to plan for taxation as far as income goes down the road.
Okay, good to be aware of that. You mentioned Roth. Stephanie, how big an impact could a Roth have versus just saving in a traditional 401k?
Well, huge. Let me just say that. And I also want to mention, when we're talking about the different buckets of money, usually over 90% of one's assets, so think of it as a big bucket, is in money that they've not yet paid taxes on. They spent all these years doing that. So this is a big subject that, again, we could spend hours on. Another thing that you need to think about too is, let's say Steve and I were married and we're retired and we're getting a pension, because Steve gets a pension from the city of Phoenix. We're going to get Social Security. So I'm getting Social Security. Steve, if he gets Social Security along, he'll get that as well. And then maybe we've got a 401k that we're going to be required to take out distributions. I'll give you an example. Bob and Mary, let's say that they were my clients and Bob was getting maybe $30,000 in Social Security, and let's just say Mary never worked, But she stayed at home raising her kids, which was a great thing. We were able to do that as well when Steve was working on the police department. And then let's say Bob had a pension. And maybe they were, in a 70,000 plus bracket. Now remember, right now you get a standard deduction. By the way, that's going away in 2026, or not going totally away, just being cut in half. But right now they get a standard deduction because they're over 65, they get a little bump up in that. But at the end of the day, their tax bracket is 12%. So maybe they're paying about $4,500 in taxes. They're great. I mean, they're living the best years of their life. They're actually making more money than they did even when he was working. And they feel like life is great. And then life throws a curveball. And Mary wakes up and finds herself a widow. Well, what happens is Mary can keep his Social Security. And this is where a lot of people get confused. Because she gets to keep the higher amount, so hers goes away. She's got to keep taking the RMDs. And they did good planning. She'll keep the pension. Now what happens is that her deduction goes down because now she's filing widow. Okay? So now it's half the deduction. Interestingly enough, she's still falling into about $61,000 that she's now going to claim on taxes. Same number that they had when they were married because they had a higher deduction. But if you look at the tax bracket now for Mary, she is pushed into not a 12% tax bracket where her and Bob were. One of the biggest jumps she's going to make now that she's a widow, she will go from paying 12% taxes to 22% taxes. Wow. From paying $4,000 and some dollars in the taxes to paying over $7,000 in taxes. Yeah. This is what a lot of people forget about. So when you're doing tax planning, you want to talk about 401ks, how to do Roth conversions. And again, if I would have sat down with Bob and Mary even 10 years ago in their 60s when they retired, we could have began doing Roth conversions. And what would have happened, we could have eliminated those RMDs that she didn't have to take, and it would have kept her in the 12% tax bracket. And by the way, potentially put hundreds of thousands of more dollars into their estate for legacy. It is essential to do tax planning.
It really is so powerful to hear in real dollars what could be at stake, and not just for yourself, but as you mentioned, Stephanie, for that legacy, what you want to leave to the next generation. If your current advisor, Steve, is not offering this type of look into tax efficient planning, is it time for a second opinion?
It is time. We don't want to put our head in the sand any longer. The train's coming down the tracks like I referred to earlier. It is time. It's imperative that we take a look to see how tax planning could affect income and legacy.
No one wants to downgrade their retirement lifestyle. It's best to be proactive on this very topic. Stephanie and Steve will continue here in just a moment. And up next, what should you be thinking about if you're nearing the final lap before retirement? We'll give you some keys to help you aim for the winner's circle. That's next.
Did you know your tax bill could go up in retirement? It's true. And for many hardworking people just like you, that could include being taxed on your IRA, your 401k, and other tax-deferred accounts. With the threat of taxes potentially increasing, your retirement could be at risk unless you take advantage of the tax saving strategies now. Defend your nest egg by downloading our free tax guide today. Help keep what's yours and avoid overpaying taxes in retirement.
You have a club for every scenario. A driver for the long holes. Wedges to get you over the hazards. And a putter for when you need a touch of finesse. What about your retirement? Will you have enough to play the back nine? Call to set your 15-minute phone visit today and let's find out. Get a second set of eyes on your retirement plan. You're watching the Fullerton Financial Show.
Ask most race car drivers, and they'll tell you success or failure hinges on the final lap. If you're nearing the last lap of retirement, Stephanie has some tips to help you get your motor running and cross the finish line with confidence. Stephanie?
Thanks, Megan. In today's Fullerton Factor, I want to talk to you about a critical time leading up to retirement. See, retirement is a lot like a race. And if you're a fan of motorsports, you know the final lap can sometimes be the most critical. Races have been won and lost by the right moves, or sometimes just small mistakes in the final lap. And when it comes to retirement, we want you to avoid a potential retirement crash and instead see that checkered flag as you cross the finish line into retirement. Many people don't realize, but there are several phases of their life when it comes to investing. See, the first phase is that accumulation part. You're 20, maybe even, into your early 50s, and your main focus of your investments is to save as much as you can, and you hope that your money grows so that one day you will feel confident that you have enough to retire. And during this time, you might see the stock market go up, which is positive, because you might see your nest egg grow. You might also see the market go down during this time, but it's not as concerning because you're still contributing into your investments even in the lows of the market. See, through dollar cost averaging, you typically will still see your investments grow over time as the market rises and as it falls. So during your accumulation years, having the appropriate amount of risk, being diligent to contribute, can help put you into a position that one day, hopefully, you'll be able to retire. But there comes a point for all of us when we will move from accumulation to what could be a long stretch of time, just like a long race, into the final lap. See, that final lap really represents the last 5 to 10 years before you retire. So maybe you're in your 50s, maybe mid-60s, but this is a time where mistakes could really cost you. There's no time for do-overs. And it's when market corrections really could have a tremendous impact on our ability to retire or retire successfully. For example, if markets were to go down 20 to 30% and you're in the final lap before retirement, would you have time to recover? See, one mistake we see families make is that they don't begin to reposition themselves in that final lap. Instead, they assume that they'll get into retirement and then make the changes that they need to make when it comes to risk in their portfolio. For a lot of families, it could be too late. Another good example of those people who were hoping to retire like in 1999, and we saw this market take a tremendous hit. And those individuals really, they had to delay their retirements 5 to even maybe 7 years. And then we saw it happen again to people who wanted to retire in 2008. And the market dropped significantly. And we saw these families having to continue to go back to work just to get back to where they were. And I hear people say, I will never let that happen again. But look, where we are right now, we're sitting on top of this bull market. And of course, we like it when the markets are doing well. But what happens if the markets drop? The plan that got you to retirement may not be the same plan you should use to get you through retirement. So it's important to adjust your risk before you get to retirement. You also need to think about setting up a comprehensive retirement income plan and make sure you're accounting for taxes and how those are going to impact your retirement income and lifestyle. And finally, planning for estate and legacy needs. So, when you're working, it's all about growth and investing in the market. It is a great way to accomplish. But I want you to keep in mind that plan might need to change. As your goals and your needs change, we always need our money growing, and there's a place for the market within a retirement plan. But more important, providing predictable, sustainable, reliable income becomes the top priority when you reach the final lap before finishing the line of retirement. So, maybe you're wondering if it's time to start lowering your risk. At Fullerton Financial Planning, we believe if you're in the final lap, that 5 to 10 years before retirement, it is time to reach out to start planning. And that's this week's Fullerton Factor. Megan, back to you.
Up next, if you have questions about retirement, stay tuned. Stephanie and Steve have answers. Stay with us.
How much do you have saved for retirement? Now cut that number in half. That's the impact inflation could have. Think about what that could do to your lifestyle and spending power in retirement. Inflation is on the rise. Protect your retirement dreams by getting this free guide to help keep it from downgrading your retirement. You can't stop inflation, but if you act now, you may be able to minimize its impact on your retirement. Get your free copy today.
Welcome back to the Fullerton Financial Show.
It's time now for your questions about retirement. And Stephanie and Steve, I know you've got the answers, so are you ready to do this?
Yes, we are.
Okay, question number 1 is from Marisol in Peoria. She says, I know I have to be mindful of taking my RMDs at age 72. What retirement accounts are subject to RMD rules?
Well, anything that you've not yet paid tax on, most likely they're going to be subject to that. One of the misconceptions are, well, Stephanie, I have a Roth IRA. Do I have to take it out of that? Absolutely not. But those accounts that you've not yet paid taxes on, know that at 72, you're going to be required to take out minimum distributions. But I also want to highlight, if you are charitable and you're given to charities, we need to talk, because there might be a way that we could take that RMD, bypass your bank account, put it into your charity's bank account, and avoid taxes on that. So there's some rules there that we want to talk about. But again, anything that you've not yet paid taxes on, that's probably a 72 rule that you're going to be required to.
Okay, so it's not something we think about when we're
Right.
contributing, but it comes quickly, doesn't it?
Yes, it does.
At age 72. All right, Stephanie, thank you. Our next question is from Dale in Phoenix. He says, my wife and I have noticed a big jump in prices lately. We have some goals to remodel a kitchen and put in a pool when we retire. But now we're worried about what prices will be like when retirement comes. Do you have a good rule of thumb to figure that out so we know if we can afford it?
Well, what we do is we use software that adds inflation, averaging about 3% per year in expenses. Because you're right, I open up a bag of chips, the bag is still the same size, but half the chips are there. So inflation is the same way. It's going to happen. So we calculate inflation into expenses. So what we do is, in our planning for retirement, is we put together a plan so we're able to hedge against that inflation to ensure that our income stays up with that. And so they are able to afford the pool or the backyard or whatever they want.
Because that's what retirement is about, right?
Should
All
be,
your
you
goals
bet.
and dreams, and
Yeah.
you want to pursue those. So smart on their part to be thinking down the road, and nice to know Fullerton helps you with that type of planning. Okay, next question is from Jacqueline in Mesa. She says, my husband and I are considering joining a retirement community that has different levels of care as needed. I'm worried about the price. What do you think about communities like that?
Well, you want to evaluate it. There's a lot of communities in our city here that you can go into, and personally, I really like them, especially if you're going into a community that there's a buy-in, and as long as you're healthy, you live in one part of the community, in one area, but as you progress and maybe you begin to deal with health challenges, there's different skill levels. That is a part of the community price. Again, you want to make sure and evaluate that everything is disclosed, that you know what you're getting. But I'm not opposed to these type of communities because I personally think that they could be really helpful. Here's a great example. I have a dear client, and him and his wife I absolutely love. And probably the hardest thing for Steve and I is that when we get clients, they tend to stay with us for their lifetime, which is a great thing. But we also get to kind of walk through life experiences with them, and we kind of see the good and the bad. And this couple, they moved into one of the communities out in Sun City, beautiful community. And his wife began to get more sick, and he could no longer care for her. And what was really great about the community that they moved into, Megan, is that he got to continue living in his independent care. And right down the hall, he was able to have his wife move into that part of the facility so she could get the 24-hour care that she needed, but they still were together. It was just a matter of walking down the hall, and I like that. There seems to still be that term of endearment where they're still connected.
And I would say also, it's appropriate sometimes to do some additional income planning if needed.
Yeah.
Because sometimes there's an increase in expenses because of the additional care and things like that. So we're able to put together some strategies that in case we need to activate to get some more income, we're able to do that as well.
And that was Jacqueline's concern, was the price. Sounds like it could be worth it, but you need to do that planning on the other side. All right, next question is from Vince in Chandler. He says, I'm 54 years old and my employer just offered a Roth 401k option. I'll probably work another 10 to 12 years. Is it worth switching to that from a traditional 401k?
Easy answer, absolutely. He's going to pay tax on it up front, which is the difference. Tax deferred versus I pay my tax now. But what I love is it will never be taxed again. So easy answer. If he can do it, do it.
And I would even say if his employer is willing to match, let's say that they're matching 4%, and if they're willing to match that in a Roth, do that as well. It is, you might feel like could get away with some taxes right now, but the power is in the compounding, and the bigger it grows, the more tax-free it is. It's golden. It's your ticket.
And I like that. Never taxed again. All right, very good. Excellent show. Learned so much as always. Stephanie, Steve, thank you.
You're welcome.
If you have a question, you can submit it, and we may just answer it on a future show. If you want to know how to generate lifetime income, reduce your tax bill, and maintain your lifestyle in retirement, we hope you'll reach out right now to start planning for your ideal retirement. For Stephanie and Steve and the team at Fullerton Financial Planning, I'm Megan Mozak, wishing you a healthy and happy journey to and through retirement.